All right, you got the disclosure page up here. As I was kind of walking through the presentation last night, I realized that I'm probably going to talk about some stocks to kind of, uh, you know, walk through the examples of some of the opportunities we're seeing. And as such, let me just give you one more disclosure. If I'm talking about a stock, I own it personally, and we own it in client portfolios. So, for those who know the firm, all of our personal wealth is invested alongside of our clients. You heard the adage talking the book. So if you hear me talking to stock today, I definitely own it. And then lastly, from a compliance perspective, I'm probably going to talk about maybe 4 or 5 stocks as examples of holdings we have. The portfolio, in particular, our all cap portfolio, this is really geared towards, we've got 30 stocks. So the 4 or 5 I talk about are just a sampling. We own, as I said, quite a few more in the portfolio. And if anybody's interested, we can certainly get you the full list of stocks in the portfolio. So with that, let me kind of jump into it. We titled this one Investing in a Period of Disruption. And, over the years, there have been, multiple sort of periods where you had major disruptions in the markets. We kind of highlighted a couple here, the 70s in particular, from an energy crisis standpoint, the 2000s coming out of the .com bubble and so forth. And today, backside of the pandemic, geopolitical situation has changed dramatically after some, lengthy period of peace. That has all changed, and more importantly, the monetary policy and certainly the fiscal policy uh, have created quite a bit of disruption. And against that backdrop, just a couple of charts here. The U.S. economy's done well over the past 5 years, and part and parcel due to the fiscal stimulus that's been pushed through the system. And part of that, as we all know, was the spark of inflation with the monetary and fiscal push. We've now seen it come off the boil, right? We peaked at roughly 9% back in the summer of 22. So inflation is now, down under that 4% level. But importantly, and we probably talked about this with you in prior meetings, the cost of living has just been reset at a much higher level, right? So while inflation has come off, prices are sort of 20% higher since 20. So that's kind of the backdrop. And when we think about sort of the period of disruption, one of the things that we've talked about is really the reindustrialization of the global economy, right? The realignment of manufacturing. The U.S. has certainly been a beneficiary of onshoring and reshoring of manufacturing, and probably nowhere more evident than in the semiconductor industry, right? We've had the passing of the CHIPS bill, roughly $280 billion worth of incentives going out to the industry. And we pulled this chart out of Intel's investor deck. And what's interesting here, what kind of jumped at us is, there's a lot of different ways to play this from an investment standpoint, right? Think about, from a standpoint of heavy machinery, right? This is kind of charting out what it takes to build one semiconductor factory, right? 250 square foot fabrication facility. You got to move about 1 million cubic meters of rock and dirt, right? So, you can look at the heavy equipment. The machinery that goes into these fabrication facilities require, again, heavy equipment to move and get this stuff in place. From a standpoint of labor, 6,000 construction workers to put this in place. But what's really interesting to us is the materials, the amount of materials that these things consume. 600,000 cubic meters of concrete for one facility, 75,000 tons of steel reinforcement bar, another 35,000 tons of structural steel, and 9 million meters of cable. So you get a sense of this is for one facility, the amount of materials it takes to do this. And we've seen, I think there's now over 30 fabs that have been announced on U.S. soil. I think the number globally is about in the 70s. So from our standpoint, what got us interested in sort of the disruption what's going on was just this massive demand on materials. And this chart here, I pulled this from the White House website, which is just mapping out sort of where the public dollars have gone. You can see across the U.S. there is just a ton of activity. Now, this takes into account not only the CHIPS Act that we just talked about, but the Infrastructure Act, the Inflation Reduction Act, and the Defense Authorization Act. In total, all of those bills are, accumulate to north of $3 trillion. So an awful lot of activity that's going into place. And, when we look at it from an infrastructure standpoint, the need for, material, things like aggregates, crushed stone, concrete, cement, asphalt. There's just this tremendous amount of demand that's coming through the system that's really not even there yet. I think we've announced sort of 7,000 transportation projects, right? We've been one of the things we follow, and I think we probably talked about it on previous calls, Stephen's probably talked to you about it. One of the things we look at pretty closely is the American Society of Civil Engineers puts out a report card on the state of infrastructure in the U.S. They do it every 4 years. And it's, it looks like one of my report cards, right? So for the bridges, we get a C. For the energy infrastructure, a C minus. Airports, D plus. Roads, D. Transit, a D minus. So there's really the state of repair of the country's infrastructure looks more akin to an emerging market than than a developed nation. So this push towards addressing those infrastructure needs is just going to command a lot in the way of as I said, materials. And one of the companies that got us very interested when we look at a beneficiary of all of this activity was CRH, which is about a $36 billion revenue business focusing on sort of the aggregates, the concretes, the cement, the asphalt that we talked about. They're going to earn over $5.40 this year. It's up on the bottom line, up about 24% from last year. They'll do over $6 in earnings next year, another double-digit earnings growth year for them. And they're trading at a little over 15 times this year's numbers and less than 13 times next year's numbers. So when you think about a business that has a line of sight in the way of demand that's growing both top and bottom line and trading at a below market multiple, that becomes pretty interesting to us. And what was really interesting about CRH is this is the Dublin incorporated company that has north of 70% of their business is generated in the U.S. Historically, they had been on the London Exchange as their primary listing. Late last year, I guess at the end of September, they switched their primary listing to the New York Stock Exchange, and part of that is the valuation gap. If you look at their competitors here in the U.S., and as I said, 75% of their business is here in the U.S., they're trading at, in one case, 32 times earnings in the case of Vulcan, which we don't own, but 32 times there. We own Martin Marietta, which trades at 22 times. So one of the things that we think is likely to happen is that valuation gap will consolidate with CRH getting a higher multiple now that it's trading in the U.S. But again, this is just an example of a business that is really set up from a standpoint of demand, standpoint of pricing power. These are projects that run multiple years, right? When we're talking about infrastructure, when we're talking about building some of these facilities, whether it's through the CHIPS Act or the Inflation Reduction Act, it's not only chips, it's battery companies for EVs. So there's an awful lot of activity going on, and these guys are sitting squarely in it from that standpoint. The other area within materials that we like is steel. I got a chart on here. When we think about the transition to low carbon, steel is going to be critical in that transition, whether it's on EVs, wind, solar. You can go right across the list here. They're going to be big benefactors of that. When you think about, just kind of going back to the Intel chart and the amount of rebar that's used in these facilities, 75,000 tons of rebar in a single facility. Part of the reason for that is the manufacturing process for semiconductors is extremely sensitive to vibration. This is highly sophisticated. You're basically creating grooves in the silicon at very micro level, right? So what they're trying to do when they build these facilities is take all of the vibration out of the building. That's why they're so rebar intensive. And we talked to a company, Commercial Metals, which we own, that's one of the largest producers of rebar here in the U.S. And when you talk to them about the business, not only that, this big push for domestic manufacturing of chips here in the U.S., but they talked a lot about the infrastructure that's going on. For them, infrastructure is really attractive because for every dollar spent on an infrastructure project, so we're talking about roads and bridges, it uses 5 to 6 times as much rebar than in your typical commercial building, right? So these are very rebar intensive businesses, and they think that over the next several years, incremental demand is going to be increasing at about a 10% rate for their business, and that's huge. They're increasing capacity. They brought on 2 mills this past year. So again, we're looking at an industry that in steel that is going to be a huge benefactor of this current environment, and again that fiscal stimulus of building out the manufacturing capacity here. I'll mention one other company in the space, which is, Cleveland-Cliffs, which is the largest producer of electrical metals, electrical steel here in the U.S., which is going to be critical. I mean, we've been hearing an awful lot about generative AI and the tax that it's going to put on power generation. There's huge consumers of energy. We're going to have to build out the electrical grid to deal with this. And Cliffs is one of the companies that's sitting squarely in sort of the catbird seat for that, because of their production of electrical steels. They talked about, the transformer business. When we look at today's electrical grid in the U.S., the current system has about, I think it's 5 million miles of transmission lines, and supporting that, there's 50 million transformers in place. Half of those 50 million were installed before 1970. So not only do we have to build out the grid, but there's going to be a tremendous need to harden the grid and upgrade the current system. And here again is a business in Cliffs that is going to be one of the huge benefactors of that. Listen, they did about $1.50. They'll do about $1.50 in earnings. That's trading at less than 12 times earnings. Commercial Metals that I just mentioned, they're trading at about 11 times earnings. So these are businesses that are very attractively priced, that are going to be, as I said, sort of sitting squarely in the space that is going to see that demand. Just one more number for you. Commercial Metals was telling us that their bidding activity, so the jobs that they're bidding on, has increased 30% over the past year. So that just gives you a sense of the business that's coming. Just one more data point for you. Eaton Corp, which is a large industrial company, in their earnings call earlier this year, talked about the fact that they're tracking what they call mega projects. And they define a mega project of more than $1 billion of capital being invested in it. They're tracking right now 330 mega projects that are taking place currently, which accounts for roughly 990 or 960 billion in capital. And of that, they said 72% of it hasn't even started yet, right? So the shovels haven't hit the ground yet. So when we talk about line of sight or earnings visibility, these are the businesses that we think are really set up to be the beneficiaries. The materials business, I just gave you steel and aggregates or building materials as two of the areas, but you could look at things like copper. You can look at other areas that within the materials business where we are invested that are big beneficiaries again across this environment. And then the last one I'll touch on is the oil industry. As we go through this energy transition, what's really what's really interesting about the oil industry is just how the dynamic has changed from a standpoint of their efficiencies. I've got up a chart here which shows you, in today, this is from EOG Resources, which is an independent producer, mainly in the Permian Basin. Again, we own it. But they can make as much money today at $44 a barrel than they did a decade ago at $85 a barrel. And that's really, it speaks to the efficiencies that the industry has gained over the years. So when you think about their ability from a geological standpoint to find the reservoirs beneath the earth, the advent of horizontal drilling has made them extremely efficient. They're now going, it used to be you go vertically down for an oil well. Now you go down and then horizontal. They're going up to 3 miles laterally in their drilling process now. And what it's allowed them to do is just get access to the, hard to find or hard to drill oil patches trapped in the shale formations at a much better efficiency than they have in the past. So what does that mean from the industry itself? It also changed how they allocate capital. This today, the energy industry today is really about return of capital. Last year, just to give you a number, last year, the 5 oil majors, so think Exxon, Chevron, Shell, BP, and Total, last year alone in 23, they returned $113.8 billion to shareholders through either dividends or share buybacks. It's just a tremendous amount of capital they're returning to you as an investor. EOG, in their last quarterly call, talked about at $75 a barrel. And, we're kind of drifting $79, $80 a barrel today. But at $75 a barrel, over the next 3 years, they will generate $18 billion in free cash flow. And of that 18 billion, they're going to return 12 billion of it, 70% of it, to shareholders through buybacks and dividends. So that, again, to us becomes a very interesting play. Listen, we are going through an energy transition to renewable energy, but it's going to take time. And certainly over the next few years, at least, we think this is an area that is going to be really interesting from an investor standpoint to get some return to capital. So, those are a couple of the areas that we're finding interesting here. Just to give you a sense of how we're positioned, if you look over to the right-hand side of the chart here, materials. We've over 20% of the portfolio materials versus the S&P at 2. So we're well above the index weight there. I talked about energy, 9.5% versus 4 for the index. So double there. That's where we're finding really the interesting opportunities. Industrials as well. We've got an overweight. So we're kind of, as I said, we're really putting capital where we think we've got the best opportunity to compound that over time. And I'll just give you one other portfolio that we manage, which is our focused ETF portfolio. The previous one was our stock portfolio, which I mentioned is a 30 stock portfolio. We also manage a ETF portfolio. So there's a portfolio of ETFs. Right now, we have 8 ETFs, and these are either sector or sub-industry or industry ETFs. Right now, if you look, we got 20% in technology. 10% of that 20 is semiconductor focused. The infrastructure, so think about the aggregates we talked about before, plus the metals and mining. So again, this gets you that steel and exposure, that copper exposure. So nearly, call that 27.5% in that material sector, 30% in energy. We're doing that through both the majors, through Phil, which is really the access to the majors, and XOP, which are the independent producers, primarily in the Permian Basin here in the U.S. And in that energy, we also included, this is an agricultural commodity index. And really the play there is we think we've got elevated energy prices here for a bit. It's the biggest input cost into agriculture. So we think, that will in turn force higher pricing for ag commodities as we look out. So we kind of lump that in there at 5%. And then we've got 10% in the industrials with the focus here on aerospace and defense. We talked a little bit about, the Defense and Authorization Act earlier in the conversation, but, it's an area that's going to see flows. The U.S., we put about 850 billion into the Defense Act. It's just, the world is just, it's a different environment. And we think it's an area that is going to continue to see capital flows as we go forward. So that's sort of, how we're positioned in this environment. We got a quote in here from Larry Summers, is, what most investors want to do today, what they should have done yesterday. Again, just kind of the idea of if you want to put your capital where capital is going to be flowing in the future. And I think that's kind of what we're thinking. Just some comments here, but really, I think at this point, I'll just kind of open it up for questions. I kind of talked a lot about where we are, but happy to elaborate on anything we touched on here. Andrew, I'm not sure if I see your question, if it's in a chat.
No, Sean, I was just raising my hand.
Okay.
When you talk about the cement and steel demand and all this construction,
Yeah.
you just give us some sort of context of time frame? Like, is there like a big burst of this for what, 3 years, 5 years, and then it tails off? Is this something that's going to go on for decades? Just
Oh,
some
I
sense.
think, yeah, I think you're looking, Andrew, sort of over the next 6 to 10 years is really when all of this will play out, from a standpoint of the build out, right? So, you're looking at some of this stuff has started. As I mentioned, Eaton, which put out the comment in their, I think it was the call earlier in the year, not this latest one, where they said, there's 330 projects that are through the design phase, and of that, less than 20% of them have shovels in the ground already, right? So it'll be a multi-year investment, and my guess it kind of runs sort of out that 6 to 10 year sort of time frame.
Sean, what also has a question.
And that is it in the chat?
Okay,
No,
so
Please,
My
please.
name. You were talking about the big industrial push in the US that is coming. Seems inevitable, taking into account the C and D classification. On the other hand, Stephen, the previous session, was talking about the big debt burden that's hanging over US in the longer term. So
Yeah.
how can fix these two things which don't come somehow together, to me at least?
Yeah, and it's a good point. So right now, I'd say you got to kind of focus on that debt servicing level, which I think we ended last year, it was about 2.4% of GDP, which, I would argue is manageable. But the trajectory that we're going on is unsustainable. I think we hit a record debt service relative GDP back in 91. And that was at 3.2%. So we're kind of creeping up on those levels. What will be interesting to see how, so there is, rightfully so, there is a focus on the debt level, but these investments have a return, and hopefully part of that return is productivity. Hopefully, part of that is increased tax receipts, right? You're gonna employ a lot more people. So there's the other side of the equation here, where again we hope there's a return on investment, so to speak. And as we look at it today, over the next few years, we think that debt service component is manageable. It can't continue to grow at those levels, though. At some point, we're going to have to curtail the amount of borrowing that's going on. So it's not a problem today. Certainly a problem, as Stephen said, as we look out, as we kick that can down the road.
Sean, even Wanda has a question.
Uh, Sean, I want to get to CRH, your example of CRH moving from European stock exchanges, I don't know which one, to the US. Stephen mentioned a few other examples, again, based on difference in valuation. Do you see it as a trend and perhaps for opportunistic investors an area to look into?
I don't know if it's a trend yet, but it's been mentioned by Shell as one, Shell Oil. And part of that is, I think, the regulatory environment that they're dealing with. And two, I think from a valuation standpoint, the numbers I've seen tossed around, it's sort of a 10% discount to say an Exxon or a Chevron. So, and management has mentioned it. So, I don't know if I call it a trend, but it's certainly something people are looking at. ASML, excuse me, is another one that's talked about it from a standpoint, I think, more of the regulatory environment that they're dealing with. So, as you run a business, you're looking to maximize that valuation for your shareholders. You're also looking, where is the most business friendly environment for you to do business. So those are some of the things that are being tossed around now. Whether that causes some change in the other jurisdictions outside of the U.S., that's quite possibly, an end result as versus sort of a mass movement to list and incorporate in the U.S. So I think Wanda, I think it's kind of too early to say a trend, but it's certainly a concern that executives are recognizing.
Does anyone else have any questions? And I think Mary, Nicholas, and Ashwini didn't get to introduce themselves. So if you want, you guys can introduce yourselves. I think they're not able to hear me. But if anyone, if no one has a question, then we can go ahead and end the meeting for the day.
Well,
Yeah,
thank you everyone for your time.
Oh, sorry.
Thanks a lot, Sean.
Thanks, Sean.
You bet.
So should we ask questions or? Yeah.
I'm here. I'm still here if you have a question for me.
Okay. So what's your take on the big technology push? This NVIDIA, Microsoft, and a huge the last few years, I mean, unprecedented growth of the biggest giants of technology. Do you see this trend continuing as these companies become even bigger, or this at certain point is going to turn around and spread the wealth more equally and between smaller companies?
Yeah, I think initially you're right. I think when you think of the Microsofts and an Alphabet or even an Amazon, they can generate the cash flows to invest just through their business, right? So they don't have to, in an environment where you've got rates high, the ability to use cash flow to invest is a great advantage, particularly given the sheer size of the capital that these guys can generate. So I think initially our thought is the bigger get bigger. But there's a lot of there'll be a lot of trial and error in the AI, in the generative AI space. But ultimately there'll be new winners. But initially, I think you're right. I think the big get bigger, and there's room for that to continue to play out, certainly over the next year or so. But ultimately, there'll be new players in the market. It's just a little bit too early to determine, for us anyway, where they're going to be. I mean, we played, sticking in the technology space. I mean, one of the names that we've owned and we think is going to be a big beneficiary is Micron, and you've seen it, right? I mean, we're now up. I don't know where the stock is today, but closing in on $130. I mean, a little over a year ago, it was probably trading in the 60s, right? But you can't. NVIDIA's needs the high bandwidth memory to do all the compute and all the things we want to do with AI. So there are going to be, tangential sort of plays within AI. It's not just NVIDIA, right? It's and I think memory is a great area that's going to benefit from that. So there's opportunity. Long-winded answer, but the point being that I do think the winners currently will continue. They've got some legs left before we see that sort of broaden out, as far as the end game.
Mm-hmm. Okay, so if nobody, I have one more question. What's your take on the big biotech players? Used to be a time that like I counted like 200 biotechs that were at more cash and the valuation was on the stock market. Then recently changed. So if you were to say what is the trend for these biotech companies, listed biotech companies, and overall biotech sector, what would you say right now? It's where is it going?
Well, listen, we'll be the first to admit we missed the GLP boat. That moved pretty quick and fast.
And it's still coming in. It's not just two companies. There will be more and more. I mean, I think 6 pharmas are playing in a clinical trial, so there will be more players very soon.
Yeah, and in the other thing I would say, part of the advances in technology with AI, I think you're going to see faster breakthroughs. I think the clinical process gets sped up because I think part of the issue is in the clinical is going down a path and not realizing it's the wrong path for too long, so to speak. I think what happens with the advent of much more powerful sort of compute processing, that you're going to see that that timeline shrink up. And what that's going to allow, I think, is more M&A activity. So, we tend to focus maybe on the smaller biotechs that have sort of a platform, if you will. And some of the names we own there is Ascendis, which sort of started in the endocrine diseases, right? So human growth hormone for kids, right? So for adolescents, and if you know anybody, the therapy in that space used to be a daily shot of HGH for like 8 years for these kids. Ascendis has a program which is moves it to a weekly shot, which is again much better for quality of life, if you will, for the kid, better results and so forth. Then they had one that we thought was going to get approval. The PDUFA date was May 15th for parathyroidism, where there is no cure in the market. It's basically a hormone deficiency that leads to osteoporosis. It's awful disease. We thought we'd get approval on May 15th. That got pushed out now to August. But again, based on what we're seeing in the clinicals, we think that goes through. The European counterpart has already approved it. And then behind that, they're in phase 3 with dwarfism program for that as well. They've also now branched out into oncology. So we're looking at a platform. This is a company that's probably, the market cap on it's probably about 8 billion, 9 billion. You think about some of the the addressable markets in HGH and parathyroid. We're each of them is probably about a $2 billion addressable market. Pick a number, so 10 times that. You're talking about substantial potential on a takeout. That becomes very interesting to us. We got another one, Biohaven, which and if you guys remember Neurotech, it was the migraine therapy that they ended up selling to Pfizer, but kept basically the team intact, all of the research intact. So their platform is still in place. They earn a royalty on Neurotech. They're doing a lot of interesting stuff in the neurospace that we think, again, as these smaller biotechs, to your point, the large guys got to grow, dealing with patent cliffs. It's a natural sort of extension that you're going to see M&A pick up, and we've started to see it. We own Regeneron, which is by no stretch a small company, right? But Regeneron, again, you guys, if you watch TV, you can't go too far without a commercial for Dupixent. It is now, I think, on its 7th indication. It's basically an anti-inflammatory that they're using across different afflictions. The latest one they're going after is COPD, which is a huge market, right? So that's kind of how we've been playing it. We think that the larger pharma is going to have to spend, right? They're going to have to buy for growth as we go forward. And we're kind of trying to traffic more in the smaller to mid space as potential targets in that space, for what that's worth.
Mm-hmm.
Going back to the whole thing you talked about, Transformers, and I guess without getting too deep into it, you got just to make it simple, Transformers, literally the one that's down the street from your house, all the way up to immense Transformers that are the cores of the central aspects of the regional parts of the grid. I saw something where we haven't built one of those in God knows how long, and maybe we don't even know how. So there's all those levels, and I think you talked about, is it Cleveland Cliffs that's in that business that you own?
So they're a steel manufacturer, right? But one of the things they do is electrical steels, right? And electrical steels are used in the transformers. They're also used in some of the EV, in the EVs and so forth. So they were at one point, they basically owned the market. As we've kind of gone down this decarbonization path, some of the bigger, we don't own Nucor, but Nucor is now into electrical steel. So they're all adapting their business to go after that market. But yeah.
I guess my question was, and maybe it's not what you were talking about, is directly looking at producing new. Just you talked about how transformers just haven't been built, and producing new transformers. And the thing that I was looking at were there's not that many of these super large ones, but you have transformers literally all the way down to the one down the street, and the one near me blew up once, and they replaced it. So clearly, people do that. And then we have things like ultra fast charging stations being put in, and those transformers need to be replaced because they just don't supply enough power, et cetera, et cetera. So, do you guys have any sort of interest, feet into that? Not the level of steel and raw materials, but the actual
And product.
businesses. Yeah.
We've, and to answer your question, we haven't found a way to play that. We're just, to be honest with you, we're looking at a business in Cliffs, right? That to us just seems mispriced, right? At 10, 11 times earnings, it just doesn't seem right. We've looked at some of the end, I think Carrier probably does something in the transformer line, obviously the HVAC and so forth. But we haven't looked at it down at that product level yet. It doesn't mean we won't, but we haven't